So the Bank of Canada has come out today and they basically said, you know what? Everything's fine. Everything's on track. Inflation is on the high end of the target, but guess what? It's expected to cool. Rates are holding. You know what? That's not what my life feels like right now. My grocery bill, my fuel, my mortgage renewal, none of that feels like it's on track.
And you know what, Jay? That's exactly what this video today is going to be about. The official number, and then there's the number that you feel, and those are two different stories. And today they're even further apart than usual. So let me show you why you're not actually crazy.
Let's just start with this official version first. Josh, what have they said?
Really, it's no change. They held the key rate at 2.25%. That's not prime, but that's what their rate is. That's the sixth hold in a row. So it's been a long time since they last changed, and it's exactly what economists and the markets expected, so it was no surprise. They said that inflation's going to ease back toward 2% by early next year, but did mention, as we all know, that housing is weak, but looks to be stabilizing, and that their current rate is appropriate.
So this is that whole everything's fine message.
That's right. So capital economics, they tend to be pretty accurate. They think that the bank's going to sit tight for the rest of the year. There's still three more decisions this year, the next one on September 2nd. So right now the headline is stability and that nothing's moving.
Okay, so stability is their message, right? That's okay. But stability with what though? Because right now, like from what I'm seeing and people I'm talking to, no one really feels stable with what's happening right now.
So that's where it gets interesting. You'll hear two inflation numbers and people do mix them up. The big one or the headline number, the actual cost of everything, it was up 3.2% in May. That means compared to May of 2025. And that's the highest rate of increase that we've seen in a year.
So this is the real number. Like this is what we're all feeling in our lives right now.
Well, that's your life. But then they'll say that core inflation is near 2%. And that's the number that makes it sound like it's not really a big deal. It's important that they look at that number because core strips out the wildest movers to find the underlying trend. However, gasoline spiked because of the war in the Middle East. You pull gas out and the inflation drops just with that down to 2.2%.
So this is pure insanity though, because okay, so let's just all stop buying gas. We wouldn't go anywhere. So clearly we still need to buy gas.
That's right. And that's the whole tension, right? Core isn't a lie, it's a tool. The bank even uses a couple of these middle measures. One is actually literally called median, the middle value. And that one trims off the extremes. The same idea as when you and I talk about median home prices instead of the average. So one $7 million sale or one really expensive barrel of oil doesn't distort the entire market reading.
Sure, I get this whole role of what the median does, Josh, but the median home price describes a home someone will actually buy, right? Core inflation describes a basket of items that I don't only get to buy the calm stuff. I have to buy what's everything in there, right? So you can't pull gas out. I still need gas.
And exactly, and that's the honest catch. Core tells the bank where things might be heading, but it doesn't do anything for what's leaving your bank account today.
Okay, so let's just talk about this basket of what they're measuring then, because it still feels like the expensive stuff exactly the stuff that's going up, and that's the stuff being left out.
You nailed it even before I said it. The basket is 8 different categories and it's weighted by how people actually spend, with the three biggest being shelter at about 28.5% of the basket. We got rent, mortgage interest, property taxes, utilities, all in that. Transportation is almost 18%. That's vehicles, insurance, and of course, gasoline lives in there. And food is about 17% of the basket.
So if we add these up,
Adding them up, that's like 63% of everything you spend. So pulling those out of the numbers doesn't feel real, right? Transportation and food are the biggest volatile ones, the exact ones getting stripped out to make the core number look calm.
right? So here's the deal: everybody relax, don't eat, don't go anywhere. We're good.
Yeah, they're saying relax by removing your biggest costs, right? And that's the cleanest way anybody's ever really said it. That's what it is.
Okay, so now here in Edmonton, we're going to hear inflation's basically 2%. But then they look at their actual month, what's left over in their bank account.
And really, they should trust their gut. They felt the number at 3.2%, but in many ways, actually, it feels worse than that because we're still feeling the impact of inflation rates from 2021, 2022, when they were 7, 8, 9%, and wages still haven't largely caught up to that. So the 3 point number today is concentrated in the stuff you can't avoid, yes, and it's only referring to the last year, but we're still feeling multiple years of higher than normal inflation. So no, you're not really imagining it, Jay, and you're not bad with your money. It genuinely costs more to live now than the headline soundbite suggests.
Yeah, so I guess this is the part where everybody's sort of feeling a bit gaslit, right? So anyway, we're all told it's fine, but none of us can figure out why we're short at the end of the month.
And on renewals, it's sharper still. Like if your mortgage is up, you're likely rolling off of a rate from 5 years ago around 2%, sometimes less than that. And variables are around 3.6, fixed rates are at 4.1 or even higher, which for a lot of people is going to be a pretty good sized jump in their payment. That's not stable for your budget, even if the bank's rate hasn't moved in the last 6 announcements.
I guess that's what bugs us then here too, right? Like here we are in Alberta, we're an energy problem. The thing that's driving this inflation is oil and gas, and yet it still seems to hit us.
That's the irony of living here, right? The oil price is pushing the national headline number up, and it's the same thing that the bank flagged as supporting Alberta's economy, energy-related investments and exports. So the factor making the country nervous is in some ways a tailwind for us here.
So we're going to feel this price at the pump, and we depend on that price for our job. So it's definitely kind of the tail wagging the dog, isn't it?
In some ways, and both are true at the same time. And on housing, for the 20 years before COVID, Edmonton was remarkably stable. While Toronto and Vancouver, they were just going up and up. And we've seen it go up, of course, since COVID started over the last 6 years. But we've never had a run up like those places did, which is part of why Edmonton is still relatively affordable today. And that's where there's opportunity in the middle of all of this.
So let's talk about some of the pain that's been deferred then, because there's a catch. A lot of the stability over the years was people borrowing against the increase in value of their homes, and then they just kept on spending, right?
And that's the trap. And it's even happened here in Edmonton, right? People use their homes as an ATM. That keeps their lifestyle going because they can refinance, pull out the equity. But deferring that isn't erasing it. The bill still shows up just later. The mortgage is now bigger and it's going to take longer to pay it off. And as a country, as a whole, we've leaned into housing to drive our economy for decades. And some of that's coming due now. And the same rules apply to a household. You don't solve a cash flow squeeze by piling it onto the mortgage.
What are we going to tell someone in Edmonton that's watching us here right now? They're thinking about their mortgage, their renewal, whether they can even afford to move. So what should we tell them, Josh?
It's really 3 things. One, you're not crazy. So plan for reality and not the soundbite. It genuinely costs more to live right now than it did years ago. Know exactly where your money's leaking and be very deliberate about that. Number 2, financial discipline over impulse. This is not the year to stretch your neck out for the boat or the toy by mortgaging your home. Protect your margin. And 3, if you're buying, buy the right property. As you like to say, Jay, buy on logic and not emotion. Don't overpay. Jay, you've got a client right now you're telling him about that is weighing or considering a house that's $40,000 more expensive. And further away, it adds 40 minutes a day to his commute. And over, say, even 15 years, that's so many hours purely because he's attached to that house. Run that math. The right property bought at the right price means you're never really stuck.
The story is rosier than the life, so let's just be sharp.
Stability on paper is your window to get disciplined. So, let's use it. I'm Josh with Mortgages for Less. If your renewal's coming, if you're wondering what you can actually afford in this market, send me a message. Contact information is in the video description, and I'll give you the real numbers for your situation and not just the headline.
Thanks, Josh. And I'm Jay. If you found this useful, follow our channel, hit the bell for notifications, leave us a comment, subscribe. We would love to sit down and talk to you about real estate, your situation anytime. For now, though, we'll see you next time. Hope you have a beautiful day.